Listen, I need you to understand something that's happening right now, something that most people won't realize until it's too late. We're sitting at a critical juncture in the precious metals market, and there's a window closing this Friday that could determine whether your retirement savings maintain their purchasing power or get decimated by what's coming next. Let me paint you a picture of what's actually happening behind the scenes. Right now, as I'm recording this, there are massive institutional players making moves that the average investor won't hear about until months from now. The COMEX futures market is showing something I haven't seen in over a decade. Open interest in gold futures has spiked by 47,000 contracts in just the last 2 weeks. That represents 4.7 million ounces of gold, worth over $12 billion at current prices. But here's what makes this absolutely critical. The commercial traders, the big banks and institutions that typically suppress gold prices, they've flipped their positioning. They've gone from being net short 280,000 contracts to net short only 140,000 contracts. That's a massive reduction in their bearish bets. You know what that tells me? The smart money knows something. They're not fighting this rally anymore. They're positioning for what comes next. Now, let me take you back to a moment in history that rhymes perfectly with what we're seeing today. It was August 1971. President Nixon walked into the Oval Office and made a decision that would change the global financial system forever. He closed the gold window, severing the dollar's last tie to gold. At that moment, gold was trading at $35 an ounce. Most Americans didn't understand what had just happened. They went about their daily lives, trusting that their dollars would maintain their value. But a small group of people, the ones who understood monetary history, they acted immediately. They moved their wealth into gold. What happened next? By January 1980, less than 9 years later, gold hit $850 an ounce. That's a 2,328% return. But it wasn't just about the return, it was about preservation. Because while gold was rising, the dollar was collapsing. Inflation ravaged the purchasing power of cash savings. People who kept their wealth in dollars watched their retirement dreams evaporate. A comfortable nest egg of $100,000 in 1971 had the purchasing power of just $31,000 by 1980. Meanwhile, that same $100,000 converted to gold at $35 an ounce would have been worth $2.4 million. I'm telling you this story because we're at a similar inflection point right now. The signs are everywhere if you know where to look. The Federal Reserve's balance sheet has exploded from $4 trillion in 2020 to over $7.8 trillion today. They've created more dollars in the last 5 years than existed in the entire history of the United States before 2008. Think about that. More than 200 years of dollar creation, matched in just 5 years. And here's what nobody's talking about. They can't stop. The U.S. government is running a deficit of $1.7 trillion annually. That's $1.7 trillion of new debt every single year that needs to be financed. Who's buying it? Not foreign governments anymore. China has reduced its treasury holdings from $1.3 trillion to under $800 billion. Japan, facing its own currency crisis, is selling treasuries to support the yen. So who's left? The Federal Reserve. They're the buyer of last resort, which means more money printing, which means more inflation, which means your dollars are losing purchasing power every single day. But gold? Gold is doing something remarkable. Central banks around the world purchased 1,037 tons of gold in 2023. That's the second highest year on record, and 2024 is on pace to exceed it. The People's Bank of China has been buying gold for 18 consecutive months. They're not slowing down. They're accelerating. Poland just announced they're increasing their gold reserves by 100 tons. Singapore's central bank has tripled its gold holdings in the last 2 years. These aren't random decisions. These are strategic moves by the people who understand what's coming. And it's not just central banks. Look at what the big institutions are doing. BlackRock's gold ETF has seen inflows of $3.2 billion in the last quarter alone. JP Morgan, the same bank that was fined $920 million for manipulating the gold market, they're now one of the largest holders of physical gold. They have over 14 million ounces sitting in their COMEX vaults. Why would they accumulate so much if they didn't believe prices were going significantly higher? Here's where it gets really interesting. The supply and demand fundamentals are setting up for a perfect storm. Global gold mine production peaked in 2018 at 3,300 tons per year. Since then, it's been declining. We're now at around 3,100 tons annually, and the trend is downward. Why? Because the easy gold has been mined. The ore grades are declining. It takes more energy, more capital, and more time to extract each ounce. Meanwhile, demand is exploding. Investment demand is up 28% year over year. Jewelry demand in India and China, which represents 50% of global demand, is at record levels despite higher prices. And then you have the central bank buying I just mentioned. So you have declining supply, surging demand, and unlimited currency creation. What do you think happens to the price? But here's what makes this Friday so critical. There's a technical setup happening in the gold market that only occurs a few times per decade. Gold has been consolidating in a tight range between $2,600 and $2,700 for the last several weeks. It's building energy, coiling like a spring. The 50-day moving average has crossed above the 200-day moving average, what technical analysts call a golden cross. Historically, when this pattern appears, gold tends to rally 15% to 25% over the following 6 months. But there's more. The relative strength index is showing bullish divergence. Price made a lower low, but RSI made a higher low. That's a classic reversal signal that precedes major moves higher. And here's the kicker. This Friday, December 20th, is the last trading day before the holiday period. Volume drops dramatically during the holidays. Liquidity dries up. And when liquidity is thin, prices can move violently. If gold breaks above $2,700 this week, there's very little resistance until $2,950. That's a $150 move, a 5.5% gain. That could happen in a matter of days. But if you wait until after the holidays to position yourself, you'll miss the initial surge. You'll be buying at higher prices, chasing the move instead of anticipating it. Now, I know some of you are sitting there thinking, but gold doesn't pay dividends. It doesn't generate cash flow. Why should I own it? Let me address that head on because it's a fair question, but it misses the entire point of what gold actually is. Gold isn't an investment. It's insurance. It's a store of value that has maintained its purchasing power for 5,000 years. Let me give you a concrete example. In 1920, a quality men's suit cost about $20. An ounce of gold also cost about $20. Today, a quality men's suit costs around $2,000. An ounce of gold costs around $2,650. Gold has not only maintained its purchasing power, it's actually increased it. Meanwhile, the dollar has lost 97% of its value since 1920. That $20 bill from 1920 would buy you almost nothing today. So when people say gold doesn't generate returns, they're looking at it wrong. Gold doesn't need to generate returns. It needs to preserve wealth. And right now, with inflation running hot, with currency debasement accelerating, with geopolitical tensions rising, gold is doing exactly what it's supposed to do. It's protecting wealth from the destruction of fiat currency. And speaking of protection, if you're sitting on $100,000 or more in retirement accounts, there's something you need to know about gold IRAs. I put together a comprehensive guide that explains exactly how this works. It's in the description below. Basically, you can move a portion of your IRA or 401k into physical gold without triggering any taxes or penalties. The gold is held in a secure vault, but it's titled in your name. You own it. And it grows tax-deferred, just like any other IRA investment. The guide covers all the details, the rules, the process, everything you need to know. If you're concerned about the dollar's future, if you want to protect your retirement savings from inflation and currency debasement, it's worth checking out. All right, back to what's happening in the market right now, because there's another layer to this story that most people aren't aware of. The COMEX, the exchange where gold futures are traded, is showing signs of stress. The amount of physical gold available for delivery has been declining steadily. We're now at just 8.2 million ounces of registered gold, the gold that's actually available for delivery against futures contracts. But there are 54 million ounces of open interest in futures contracts. That's a ratio of 6.6 to 1. For every ounce of physical gold available, there are 6.6 paper claims on it. Now, most futures contracts are settled in cash, not physical delivery. But what happens if even 20% of contract holders demand physical delivery? The exchange doesn't have enough gold. They'd have to go into the market and buy it, driving prices significantly higher. And we're already seeing signs of this happening. In November, 47 tons of gold were delivered on the COMEX. That's the highest monthly delivery in over 2 years. Somebody is taking physical possession. They're not rolling their contracts forward. They're not settling in cash. They want the metal. And when you see this kind of behavior, it tells you that sophisticated players are losing faith in paper promises. They want the real thing. This is exactly what happened in the lead-up to the 2011 gold peak. Deliveries started spiking. The spread between paper gold and physical gold started widening. Premiums on physical coins and bars went from 2% over spot to 8% over spot. And then gold went from $1,400 to $1,900 in just 6 months. We're seeing the same pattern now. Premiums on American Gold Eagles are running 6% to 7% over spot. That's double the normal premium. Dealers are reporting delays in getting inventory. The U.S. Mint has been rationing gold coins to authorized dealers because they can't keep up with demand. These are not signs of a market that's about to decline. These are signs of a market that's about to explode higher. But let's zoom out even further, because there's a macro trend happening that's going to drive gold prices for the next decade, and most people have no idea it's even occurring. The global monetary system is being restructured right now. The dollar's dominance as the world's reserve currency is being challenged in ways it hasn't been since World War II. The BRICS nations, Brazil, Russia, India, China, and South Africa, plus the 40-plus countries that have applied to join, they're building an alternative financial system. They're settling trade in their own currencies, bypassing the dollar entirely. China and Saudi Arabia just completed their first oil transactions settled in yuan, not dollars. That's monumental. The petrodollar system, which has been the foundation of dollar dominance since 1974, is cracking. And what are these countries using as the foundation of their new system? Gold. Russia has increased its gold reserves from 600 tons in 2010 to over 2,300 tons today. China's official reserves are listed at 2,200 tons, but analysts believe the real number is closer to 4,000 tons because they've been buying through back channels to avoid moving the market. These countries are preparing for a world where the dollar is no longer the dominant reserve currency. And in that world, gold becomes the ultimate neutral reserve asset. Now, I want to take you inside a specific moment that illustrates just how fragile the current system is. It was March 2023. Silicon Valley Bank collapsed, then Signature Bank, then First Republic. The banking system was on the verge of a full-blown crisis. The Federal Reserve had to step in with emergency lending facilities, providing $300 billion in liquidity to prevent a complete meltdown. And what happened to gold during this crisis? It rallied from $1,810 to $2,050 in just 3 weeks, a 13% gain while the stock market was in freefall. That's what gold does. When the system shows cracks, when confidence wavers, capital flows to safety. And there is no safer asset than physical gold. It has no counterparty risk. It can't be printed. It can't be debased. It can't default. It just is. And here's what keeps me up at night. The banking crisis of March 2023 wasn't resolved. It was papered over. The Fed provided liquidity, but the underlying problems, the unrealized losses on bank balance sheets, the commercial real estate exposure, the duration risk from rising interest rates, none of that was fixed. It's still there, lurking beneath the surface. And when the next crisis hits, and it will hit, the Fed's response will be the same. Print more money, provide more liquidity, debase the currency further. That's why this window closing Friday is so critical. We're in the calm before the storm. Gold is consolidating, building energy, preparing for the next leg higher. But once it breaks out, once it clears $2,700 and starts making new all-time highs, the psychology changes. FOMO kicks in. Retail investors who have been sitting on the sidelines start piling in. And that's when you get the parabolic moves, the kind of moves we saw in 1979 and 1980, when gold went from $200 to $850 in just 18 months. Let me share another historical parallel that's incredibly relevant right now. In 2008, during the financial crisis, gold initially sold off. It dropped from $1,000 to $720 as investors liquidated everything to raise cash. People looked at that and said, "See, gold isn't a safe haven. It went down during the crisis." But they missed what happened next. From that $720 low in October 2008, gold rallied to $1,900 by September 2011. That's a 164% gain in less than 3 years. Why? Because the Fed's response to the crisis was to print trillions of dollars. QE1, QE2, Operation Twist, all of it was currency debasement. And gold, being the ultimate currency hedge, reflected that debasement in its price. We're in a similar setup now. The Fed has paused rate hikes. They're signaling cuts in 2025. The market is pricing in 3 to 4 rate cuts next year. And every rate cut, every move back toward easy money, is bullish for gold, because rate cuts mean the Fed is prioritizing economic growth over currency stability. They're choosing inflation over deflation. And in that environment, hard assets like gold thrive. But here's the part that really matters for retirees, for people who have spent decades building their nest egg and are now trying to preserve it. The traditional 60-40 portfolio, 60% stocks and 40% bonds, it's not working anymore. Bonds got crushed in 2022 when rates spiked. The aggregate bond index lost 13%, the worst year in its history. And stocks? The S&P 500 is trading at a price-to-earnings ratio of 24, well above its historical average of 16. That's expensive. That's priced for perfection. And in a world of slowing growth, rising deficits, and geopolitical instability, perfection is unlikely. So where do you go? You need an asset that's not correlated to stocks and bonds. You need an asset that performs well during periods of currency debasement and financial instability. You need gold. And the data backs this up. Over the last 50 years, gold has had a correlation of just 0.1 to the S&P 500. That means it moves independently. When stocks zig, gold often zags. In 2022, when both stocks and bonds were down double digits, gold was down just 0.3%. It essentially preserved capital while everything else was getting hammered. That's the power of diversification into real assets. Now, let's talk about what happens after Friday, because the technical setup suggests we're about to enter a very explosive phase. Gold has been in a bull market since December 2015, when it bottomed at $1,050. Since then, it's rallied to $2,650, a 152% gain. But here's what's interesting. That entire rally has been orderly. There hasn't been a parabolic blow-off top like we saw in 1980 or 2011. This has been a steady, grinding bull market, the kind that can continue for years. And the fundamentals support much higher prices. If you adjust the 1980 peak of $850 for inflation, gold would need to reach $3,200 today to match that high. If you adjust the 2011 peak of $1,900 for inflation, it would need to reach $2,650. We're right at that level now. So, in real inflation-adjusted terms, gold isn't expensive. It's fairly valued. And if we get the kind of monetary chaos that I believe is coming, if we see another round of massive money printing, if we see the dollar's reserve status continue to erode, gold could easily exceed those inflation-adjusted highs. Some analysts are calling for $3,500 gold by the end of 2025. Others are more aggressive, targeting $5,000 within 3 years. Are those numbers realistic? Let's do the math. Gold is currently at $2,750. To reach $3,500, it needs to gain 32%. To reach $5,000, it needs to gain 89%. In the context of a currency crisis, those aren't outlandish targets. In 1979, gold gained 126% in a single year. In 2010, it gained 29%. So a 32% to 89% gain over the next 1 to 3 years is entirely plausible given the setup we're seeing. But here's what you need to understand. Timing matters. If you wait until gold is at $3,000 or $3,500 to buy, you've missed a significant portion of the move. You're buying at a point where the easy gains have already been made. But if you position yourself now, while gold is consolidating, while it's building energy for the next leg higher, you capture the entire move. You buy at $2,750 and ride it to $3,500 or beyond. And this Friday represents a unique opportunity because of the holiday liquidity dynamics I mentioned earlier. If gold breaks out this week, it could gap higher when markets reopen in January. You could wake up on January 2nd and see gold trading at $2,800, having missed a $150 move in a matter of days. That's the risk of waiting. Now, I want to address something that I hear all the time from skeptics. They say, gold is just a rock. It has no intrinsic value. It's only worth what someone else will pay for it. And on the surface, that sounds logical, but it completely misunderstands what money is and what value means. Gold has been money for 5,000 years. It's been used as a medium of exchange, a store of value, and a unit of account across every major civilization in human history. The Romans used gold coins. The Byzantines used gold coins. The British Empire was built on the gold standard. The United States was on a gold standard until 1971. Gold has outlasted every fiat currency ever created. The average lifespan of a fiat currency is 27 years. The dollar has been a pure fiat currency for 53 years, well beyond the average, and it's showing signs of age. So when people say gold has no intrinsic value, what they're really saying is they don't understand monetary history. They don't understand that value is subjective, that it's determined by what people are willing to accept in exchange for goods and services. And for 5,000 years, people have been willing to accept gold. That's not going to change because some economist says it should. In fact, gold's value is becoming more apparent, not less. As trust in institutions erodes, as central banks debase currencies, as geopolitical tensions rise, people are rediscovering gold's role as the ultimate form of money. It's not controlled by any government. It can't be manipulated by central banks. It's finite, scarce, and universally recognized. Those properties make it incredibly valuable in a world of infinite currency creation. Let me give you one more example that really drives this home. In Venezuela, the bolivar has lost 99.9% of its value due to hyperinflation. People who kept their wealth in bolivars have been wiped out. But people who converted their bolivars to gold, even at high premiums, have preserved their wealth. They can still buy food, medicine, and other necessities. The gold didn't change. The currency collapsed around it. And that's the lesson. Currencies come and go, but gold endures. We're not in a hyperinflation scenario in the United States, at least not yet, but we are in a currency debasement scenario. The dollar is losing purchasing power every year. Official inflation numbers say 3% to 4%, but anyone who buys groceries, pays rent, or fills up their gas tank knows the real number is much higher. Your dollars are worth less every single day. And that trend is accelerating, not slowing down. So the question isn't whether you should own gold. The question is, how much gold should you own, and when should you buy it? And my answer is this. You should own enough gold to protect your purchasing power if the dollar continues to decline. For most people, that's 10% to 20% of their investable assets. And you should buy it now, before this window closes on Friday, before gold breaks out to new highs, before the next crisis hits and everyone is scrambling for safety. Because here's the reality. When the crisis comes, when the system shows its cracks, it will be too late. Premiums will spike. Availability will dry up. Prices will gap higher. You'll be competing with millions of other people who suddenly realize they need protection. And you'll pay a much higher price for that protection than you would today. This is your moment. This is your window. The setup is perfect. The fundamentals are aligned. The technicals are coiled. The institutions are positioned. The central banks are buying. The supply is constrained. The demand is surging. Everything is pointing to significantly higher gold prices in the months and years ahead. Don't let this opportunity pass you by. Don't be the person who looks back in 2 years and says, I knew I should have bought gold when it was at $2,150. Be the person who acts now, who positions themselves ahead of the move, who protects their wealth before the storm hits. Because the storm is coming. The signs are everywhere. And gold is the shelter.